Hey folks, Serge Berger here for another little video on the markets, keeping you updated and informed. And today it's going to be a little bit of a educational video in the sense that we're going to look at and address the question whether the 200-day moving average is important. And in order to address that question, we are going to just look at a couple of charts, two charts. First of all, let me just say right off the bat, I think a lot of people focus on the 200-day moving average because number one, the media always talks about it, and number two, because it's a very simple oversimplification of things. Nevertheless, 200-day moving average does, in my opinion, hold some value. Now, there's one specific thing though people do wrong. Before I get to that though, let me say something in terms of how it's being used in the professional circuit. There is several fund managers, one of them being very prominent one, Paul Tudor Jones. Even he is on the record of saying that he uses the 200-day moving average as a reference point, and I'll get to that in a second. So the way we use it, and the way you can use it on most every chart, is to use it as exactly that, as a reference point. And very simply, and this is also what someone to the likes of Paul Tudor Jones says, is that a stock, a commodity, a currency, whatever you have, futures contract, is in an uptrend, in a well-defined uptrend, if it is trading above its 200-day moving average, and it is choppy or not in a defined uptrend if it is trading below its 200-day moving average. Here we're looking at a very simple chart of the S&P 500. These are daily increments, so which is to say that this red line is the 200-day moving average. And you can see there is absolutely some credence to that statement if the S&P 500 price is trading above the 200-day moving average. It does tend to be in that uptrend until it ultimately breaks below it for a period of time. And then once again, it gets back above its 200-day moving average and it establishes itself above there for a new uptrend. And I think this is really the number one point that people mistake, and a lot of it has to do with to some extent being uninformed, but maybe, dare I say, people tend to be quite lazy. We as human beings try to find shortcuts. And so what people tend to do, and this is the biggest mistake that I see with using moving averages, whether a simple moving average or averages or exponential moving averages or whatever else there is that they are using them as hard lines in the sand at which they need to either get into a position or get out of a position, whether that's from a trading perspective or an investment long-term horizon perspective. And I think that is very, very dangerous and probably is not going to work over time. Let me show you why. We're looking at the S&P 500. Let's have a look at another chart just so you guys can see that this works on other charts. Let's have a look at, for example, JP Morgan. This is a stock price, right? An individual stock price. So let's assume that you wanted to get long JP Morgan, and I'm going to just pick a certain point here. There's no specific point necessary, but let's assume you were to get long by JP Morgan as it goes above the 200-day moving average right here. Let me zoom in even closer, and you have a little bit of a trade, but then soon enough it starts breaking back below that 200-day moving average. If you're using 200-day moving average as a to the penny defined level to either get long or short or stop yourself out of a position, you are going to get chopped out of the market. It's going to frustrate you and you're probably not going to make it work. Because you can see time and time again, even though the moving average does work and it's important as a reference point, if all you do is use it for exactly what I just explained, you're going to get chopped out. What you need to have is a price establish itself above the moving average or below the moving average if you want to go short for a period of time. The best example I can give you is, an example I can give you is here, for example. You can see we break above the 200-day moving average. The stock price, I should say, breaks above the 200-day moving average. It then finds support, rallies, comes back, finds support again, rallies. You need to see an establishment above a 200-day moving average in order to actually go long. Just a little peak above it doesn't count. In fact, a simple thing you can do is you can make your chart a weekly chart and then make sure you get at least at the very least, a weekly close, a close on a weekly closing basis of price above the 200-day moving average if you want to go long, or below the 200-day moving average if you want to go short or stop yourself out of longs. So expanding that time horizon is important. And again, it's about establishing above the moving average or below the moving average. That's really the important point. And that's also certainly how I use it. I wouldn't want to put words in anyone else's mouth, such as Paul Tudor Jones, but I would be very surprised if that's not how they use it also as a reference point. So anyway, folks, I hope this was helpful. If you have any questions, comments, please do leave them down below. Share what we do here, subscribe, and I'll see you guys soon.